It's pretty widely accepted in the modern world that a government needs to tax its people. While some out there may think a government shouldn't spend too much and should leave things to the free market where possible, it's hard to deny that the government needs to spend money on at least some things, like the police force, fire departments, defence and healthcare, at least to some extent. The main way that a government gets the money to spend on these things is, of course, tax. However, what's the best way to tax people? Many of us may take the current tax system for granted. We see income taxes, taxes on our spending, taxes on business profits, and on many other things. We may think certain taxes should be a little lower or a little higher, but taxes on the whole seem to be largely accepted. But why? How do we know what is the best way to tax people? This is a question that optimal tax theory aims to answer. In 1897, a man called Francis Edgeworth said that a government that wanted to maximise the utility of an economy should make the marginal utility of every member of that economy equal. What this actually means is that if we make a few simplifying assumptions about the way people behave, then the best possible set of taxes will make everyone have the same income after tax. This would mean everyone can buy the same amount of stuff and thus should be equally happy. This will be the best outcome because people have what is called diminishing marginal utility. This says that each additional pound or dollar that we earn brings us slightly less happiness than the previous pound or dollar we earned. Give a pound to a rich man and he won't really gain much from it, but give a pound to a very poor man and it will probably make him quite happy. He will gain a lot of utility from spending that pound. With this assumption, the best possible outcome must be that everyone earns the same amount, because it increases the utility of an economy to transfer money from richer to poorer people, until everyone has the same amount and we can't transfer money anymore. So let's for now assume that this theory is correct, and that we want everyone to have the same income after tax. Okay, but what is the optimal tax system to achieve this? Optimal tax theory says that the best way to do this is to actually tax people based on their productivity. Taxing more productive people means putting a tax on the people who are naturally more intelligent or have natural ability which allows them to produce more or to perform better at work. Why would we do this? Well, people who are born with higher natural productivity will tend to earn higher wages. These people were lucky enough to be born with natural ability that will help them to get high-paying jobs. Optimal tax theory thus says the fairest way to tax people is to tax these people that were gifted at birth in order to level the playing field. This is very different from an income tax, because with a productivity tax, we're taxing people who should be earning high wages because they're intelligent or naturally productive, but we're taxing them before we know anything about what they actually earn. Their actual income doesn't change this tax at all. Why does economic theory say that a productivity tax is better than an income tax? Well, this is because there's a key problem with taxing people based on their income. People can change their behaviour to avoid an income tax. They can reduce the amount they work. If I'm a government and I tax away, say, 40% of your income, you might decide that you don't want to work as hard because the return you get from slaving away at your job is so much lower. This is a big problem with income taxes because people working less hard can really damage an economy. It's actually strongly grounded in economic theory that income taxes can do more harm than they do good. This is because a tax on incomes causes a distortion to the market. The income tax is effectively changing your wages, so it changes how people allocate their time between work and leisure. People changing their behaviour like this will cause what we call a deadweight welfare loss, because people will work fewer hours and they will earn less for each hour they do work. These losses, according to economic theory, will be greater than the tax revenue that the government receives from the income tax, so the economy has lost out overall. There is a deadweight loss in welfare. This, however, is not the case with a productivity tax. Taxing people's productivity will not cause them to work less hard or, in theory, to change their behaviour at all. So there's no market distortion here and thus no deadweight loss. This is because people can't change their natural productivity. This isn't something you have control over, you're just born with it. If the government levied a tax on your productivity or, say, your intelligence, this would not change wages in the economy or change any prices at all. If the tax doesn't change any prices in the economy, then it isn't going to cause any market distortions. This tax then allows the government to generate as much revenue as it needs without having to cause all these terrible distortions that we get with income taxes. Sure, intelligent people wouldn't be happy that you're taxing them on something out of their control, but this tax isn't going to make them work any less hard. If anything, this tax should make intelligent people work even harder, because we've taken money away from them that they now need to work to earn back. So, if a productivity tax is so perfect, why aren't we using it? Well, a government doesn't observe someone's natural productivity. We could try to observe this by doing various tests, like an IQ test or school teachers doing an evaluation of how gifted a student is from a young age. However, if we taxed people who did well on their IQ tests, they would probably be smart enough to deliberately do badly on the test, so they wouldn't be taxed as much. This means we cannot tax someone on their innate productivity, because someone could pretend to have low productivity in order to avoid this tax. The tax doesn't really work in practice. So, we've established that taxing incomes is bad, and taxing innate productivity is impossible. So where do we go from here? Gregory Mankiw and Mankiw and Wienzierl wrote a paper in 2009 in which they suggested that people should be taxed on something else, their height. The reason for this is that someone's height is actually strongly correlated with his or her income. For example, a study by Case and Paxson in 2008 said that for both men and women, an additional inch of height is associated with a 1 to 2% increase in earnings. This fact has been confirmed by a number of other studies, with taller people, on average, earning a significant amount more than shorter people. What this implies is that someone's height is linked to their natural productivity. Taller people, on average, will be more productive than shorter people. It is very important to note the point that this is on average. There will of course be short people who are highly intelligent and are very productive, and tall people who aren't very productive at all. But, for the purposes of a tax on productivity, this doesn't actually matter. As long as tall people on average are more productive than short people, Mankiw and Wienzierl say that a tax on height should be the way to go. Because tall people tend to be more productive, this tax will act very much like a tax on productivity. The other reason for a tax on height is that people can't change their behaviour to avoid the tax. People aren't in control of how tall they are, so we won't have any market distortions from people changing their behaviour. This means that a government can raise tax revenue from a tax on height without getting the negative impacts that come about from income taxes. It is worth explaining why tall people tend to earn more. One possible explanation for the height-income correlation is that taller people have higher levels of self-esteem from when they're teenagers onwards. This confidence they gain from their height may lead them to obtain better jobs and earn more. Some studies have given another possible explanation, that tall people were, on average, better nourished as children. So while they've developed more in terms of height, they have also developed more brain power than the average short person, making them more productive. Studies have shown that both of these effects are likely to be contributing to the positive relationship between height and income. you might have actually noticed that business executives, CEOs, and even US presidents are, on average, taller than the wider population. In their paper, Mankiw and Wienzierl went on to actually calculate the optimal tax on height. They found that this optimal tax is actually quite a lot. The way to go about doing this is to have a tax on height as well as a tax on income. This way, tall people who don't earn very much will not be so negatively affected by the policy, and short people who are really rich will also still have to pay tax. Their paper said that a tall person earning $50,000 a year should pay about $4,500 more in taxes than a short person earning the same amount. Both of these people would still have to pay some income tax, but the tall person has to pay more in overall taxes. In reality, of course, a tax like this will never be put in place. When you bring up the idea of a tax on height, most people will think you're either crazy or telling a joke. Or, hopefully, they will click on your YouTube video. But why is this? The explanations given for a tax on height should, at least to an economist, make a lot of sense. It follows from economic theory, and in practice could actually be a better alternative than a pure tax on income. But maybe people don't think it's fair to tax someone on something that's out of their control. For example, it might be hard to explain to a tall person that they have to pay more in taxes than a short person who has the same income, because as a tall person, they had a better chance of earning more. The idea of a tax on height is to level the playing field because tall people were born with an advantage over short people. The tax is thus meant to be fair, but it doesn't really seem fair. People may also have a problem with this tax because they don't like the idea of taxing people on their demographic characteristics. They may think that a height tax might set a dangerous precedent for targeting policies at certain groups of people. However, modern taxes and policies already do this to a great extent. Taxes may be targeted at certain areas or certain characteristics such as the number of children, marital status, and disabilities. However, these are usually negative taxes or subsidies, so these demographic groups actually like the policy. The policies that targeted groups don't like are usually implemented in a subtle way so that we don't realise a tax is targeted at that certain group. This is tied in with the idea of stealth taxes, where a government will make taxes overly complicated so we don't realise the actual implications of the tax. One example is value added tax, VAT. This is a very common tax on all goods sold. However, we're likely to blame businesses for having high prices rather than blaming the government for levying a tax on the good. This is because the person buying the good doesn't pay the tax. The business selling the good does. VAT is also not necessarily equal on all goods, so a government can sneakily tax people who buy certain types of goods without them ever noticing. Maybe a height tax is too obviously discriminatory against a certain group of people, so it has no chance of ever getting enough support to be implemented. No politician is ever going to suggest this policy because they'd be laughed out of office. What we have to conclude from this exercise is that if we reject a tax on height, we also have to reject much of optimal tax theory. When our theory tells us to do something that we clearly are never going to do, there must be something wrong with that theory. As an economist, a tax on height could be an interesting thing for a government to explore. However, as a human being, it would be a terrible idea for a government to even consider this, and that is exactly why they never will. For now, the current tax system and all its distortions appear to be here to stay. That will conclude this video. Please do drop a like if you found it interesting, check out my recent video on the value of time, and as always, subscribe to add some econ to your subscription feed.